So today we're going to tackle a question that, it seems pretty simple on the surface, but it's actually way more complex than you'd think. And that is, how do you really measure business success? Because I'll tell you, it's not just about the profit. We're going to build a kind of toolkit that helps you see the much bigger picture and really understand what makes a company a winner. Let's dive in.
I mean, think about it. How do you know if you're actually winning? It sounds like a simple question, right? But the answer, well, it's complicated. Are you actually ahead of the pack? Are you in a sprint right now, or is this more of a marathon? The key to knowing the answer is knowing what questions you should even be asking in the first place.
Okay, so here's the first thing you've got to get your head around. A company can be pulling in a profit one month and then be totally bankrupt the next. So how does that happen? Well, it's because profit is just one little piece of a much, much bigger puzzle. It doesn't show you the competitive landscape. It doesn't tell you where you are on your journey. To see the whole picture, you need a better set of tools.
All right, tool number one in our manager's toolkit is all about context. I mean, you can't measure your own success in a vacuum, right? You absolutely have to know how you stack up against the competition, and that all starts with figuring out your peer group.
And look, a peer group isn't just any other company out there. They are your direct rivals. These are the companies chasing the very same customers you are, with products that are pretty darn similar. Nailing down who they are is step one in any serious kind of performance check.
And this is a perfect example, right? The classic rivalry. If you're running things at Coca-Cola, you live and breathe PepsiCo's numbers. You're constantly looking at their sales growth versus yours to see if you're gaining or losing what we call market share, which is basically your slice of the total pie. It's like a financial tug-of-war playing out all over the globe.
Okay, let's move on to tool number two. Think of this one like a GPS for your business. It's not telling you where you are on a Mac, but something even more important, where you are in your company's own unique journey.
And this timeline, it lays it all out perfectly. Generally speaking, companies go from this really volatile startup phase, where just surviving is the name of the game, and then they hopefully move into a more stable growth and maturity phase. And a company's strategy, what winning even looks like, it has to change dramatically depending on where it lands on this timeline.
And this is where it gets really interesting. See, in that startup phase, cash is absolutely king, mainly because you're often burning through it way faster than it's coming in. The goal is pure survival, which means you need a safety net of extra cash, what we call liquid reserves. But once a company gets more mature, it's a whole different ballgame. Cash flow is stable, so you can start using other people's money, like bank loans or selling stock, to really fuel some major expansion. It's a completely different playbook.
All right, so we've sized up the competition, we've figured out the company's life cycle. Now it's time for tool number three. This one lets us zoom right in on the day-to-day heartbeat of the business, the flow of cash itself.
At the core of any healthy business is this really efficient operating cycle. It's a pretty simple three-step dance. You make something, you sell it, and then you collect the cash. But the speed of this cycle, that is absolutely critical. Just imagine a grocery store versus a company that builds airplanes. Their cycles and their need for cash are worlds apart.
And that's the bottom line, right? It all comes down to speed. A slow cycle just means your cash is all tied up. You might have made a ton of sales, but if you haven't actually collected the money, well, you can't pay your employees, you can't pay your suppliers, you can't even keep the lights on. A fast operating cycle is like a strong, steady pulse.
Okay, so we've got this awesome toolkit. But here's the thing, managers aren't the only ones looking at this data. A company's financial reports are kind of like a public dashboard. And trust me, there are a lot of different people watching it very closely.
So who are all these people? Well, let's break it down, because there are basically three main groups of people watching. And what's interesting is they're all looking at the very same numbers, but they're asking totally different questions. And they're often using the exact tools we just talked about to find their answers.
First up, you've got the watchdogs. We're talking regulators and big-time investors. What are they looking for? Safety and stability. They're going to be scrutinizing that cash engine we mentioned, looking for any little slowdown that might signal some risk. At the end of the day, their job is to prevent disasters by making sure the company's playing by the rules and isn't hiding any nasty surprises. Next up, you have the people who already own a piece of the company, the shareholders. They're looking at this dashboard with a really simple question in mind. Should I hold on to my shares, or is it time to sell? They'll use that company GPS to see if it's still in a high-growth phase or if it's maybe settling down into a more mature, dividend-paying company. Their whole decision really depends on that context. And finally, you've got everybody else. All the people who might want to buy in. Potential stockholders are kind of like shoppers. They're using that competitor scanner to see how your company stacks up against its peers.
They're digging into your past performance to try and guess if you're going to be the winner in the future.
All right, let's put all this into practice. Let's make it real. Imagine a brand new tech company. It's clearly in that super exciting but also super dangerous startup phase. And right now, more money is going out than is coming in.
So think about it. Using everything we've just learned, what's the one thing, the absolute number one thing that manager needs to make sure they survive this month? What's the resource that will decide if they make it to next month or have to just shut the doors for good?
And the answer? It's all about those liquid reserves. That extra pile of cash sitting in the bank, for a startup, that is not a luxury. It's a lifeline. It's the fuel you need to get through those early days of negative cash flow until your operating cycle really kicks into gear and the business can start sustaining itself. This is probably the most crucial point for any new venture. So there you have it. We've built this really powerful toolkit that goes way, way beyond just looking at a simple profit number. Now you can analyze a company's competition, you can understand what stage of life it's in, and you can check the health of its cash engine. So the real question is, the next time you look at a business, what are you going to see that everyone else misses?